My name is Nicole Zammit. I'm one of the district vice presidents at Fidelity Investments. Essentially, my role is to act as a liaison between our advisors and our portfolio managers and in-house economists to really and ultimately help build out resilient portfolios for our investors. At the end of the day, we're here to work hard for your money to make sure that we're growing your assets. So today is really going to be about giving you an update from what we're hearing from our portfolio managers, hopefully give you some sound bites, some concepts, a little bit more understanding as to what's caused all the volatility year to date. I know it's been a very, very challenging year, but also maybe what we can look at going forward. And then I'm also going to give a few updates on some of the funds that you may or may not be invested in, but how you can kind of build out a more well-rounded, diversified portfolio. All right, so I'm going to get started. Like I said, we're just going to give a brief market update, or not brief. I'm going to go pretty in depth in details. Then I'm going to talk about some of our best ideas. And then, like Cherry said, we'll leave the last 10 minutes for any questions. All right, so if everyone can see my screen, these are all the major indices as of yesterday's close. So you'll see here, year-to-date numbers, very broadly speaking, are all negative. No matter what geography, what region, what asset class, whether you're in stocks or bonds, you're seeing negative red all the way down. And that's the same thing with the one-year number as well. So it's been a very, very challenging market. You'll notice here, the 1 month number looks a little bit more positive. Since about June 15th, we've seen a pivot in the market. There's been a little bit more relief on the backs that, we've already sold off so much. Things are starting to look a little bit better. The markets are a forward-looking mechanism, meaning that they're discounting information that they assume is going to happen in the future. So given the fact that the markets have, been discounted so much and corrected so much, markets had the belief that, there's a lot more optimism moving forward. So we've seen a little bit of a relief in the market, especially today after we got a positive or better inflation reading in the US, which I'll touch upon later. But, just it's a good reminder that if you were sitting in cash or if you weren't invested in the market, that you would have missed out on, say, 10 to 13% rally in some of the major indices. Now, just looking here, the S&P, TSX, has held up relatively well. That's the Canadian stock market, predominantly because of the high concentration in the energy sector. If you look across most sectors in the market, energy is one of the best performing ones, and that's for the obvious reasons. Now, looking here, one thing I do want to point out is bonds. If anyone has bonds in their portfolio, they would have been hit particularly hard, and it's a very unfamiliar territory to get hit this hard in fixed income. And that's because of the correlation with bonds and rising rates and interest rates. When inflation and rates go up, your bond portfolios will go down. And because we're seeing inflation at 4-decade high rates, it's taken a big hit on your portfolio. Now, the outlook for fixed income or bonds is a lot more optimistic moving forward. We think that we could see a pivotal moment going forward. So it's not the time to lose faith is all I have to say about the fixed income. So a lot of you might be gaining exposure to bonds in your portfolios if you have any sort of balanced portfolio when you have a mix between equities and bonds. Now, moving forward, this is the business cycle. It's always important to understand where we are in the business cycle to really understand how different asset classes perform, how different regions perform, and why. So very broadly speaking, you can see here that most countries actually sit between the mid phase right here and also the late phase of the market cycle. I would say that this cycle is also one of the quickest cycles that we've ever endured. Okay, so just last year, we were coming out of the pandemic, we were really in the recovery phase. So we were on the early phase of the market cycle. That's when the markets were doing extremely well. Companies' profits were really growing at a tremendous rate. In the beginning part of this year, we were in mid phase of the market cycle. This phase typically lasts 2 to 5 years, and we've already surpassed the peak point and have already landed right here in the late phase. This is unprecedented. Most cycle lasts about 5 years to 7 years in total, and we're already here within a year and a half. So a lot of things in your portfolio that worked very, very well last year, it's not abnormal the fact that we're starting to see those other areas of your portfolio maybe shine, or those part of the portfolio not do as well. So late cycle, what that typically means is that you'll start seeing a slowdown in growth. You'll start to see companies' margins come down. You'll also see what's called a deceleration in earnings, which means that companies' earnings will start to really come down. Not necessarily negative, just not at the same sort of rate that we've seen historically. So over the past couple of years, earnings were growing anywhere between 40 to 50%. What that means is that companies' profits were growing at a high double-digit returns. Now it's about 8 to 10%. So it's still positive. It's just not the same rate as what we are seeing, over the past couple of years. So all that means is you have to adjust your expectations as to what you can get out of your equity portfolios, out of your stocks. We were all getting very, very comfortable with having high double-digit returns in our equity portfolios. I think it's time to start adjusting and maybe averaging out 8 to 12% in some of your equity portfolios for the next foreseeable future. Being in the mid phase, which is where we spent most of the time this year, you see corrections of 15 to 20% most often in the mid phase of the market cycle. Again, it's part right here where we spent most of our time in 2022. So the fact that we saw a big correction isn't abnormal. It's actually a very normal part of where we are in the business cycle. So a lot of our portfolio managers, all in all, weren't too concerned about this. Another thing that I'd like to highlight is the fact that the UK and EU is now on the brink or on the verge of entering into a recession. I would say that's in large due to the proximity of the war and all the implications surrounding that. Russia's weaponizing their oil supplies, so that's really impacting the EU and UK, specifically those countries that were solely reliant on those areas. In the UK, they're spending 56% more on their energy bills than they were last year. This is really eating into consumers' spending, and unemployment's really high in Europe. Inflation is in double digits. They're starting to raise rates quite significantly. So things are looking a little bit more bleak over in Europe. Now, in terms of China, they're still in what's called a growth recession. They've been here for a fair bit. It's predominantly due to the anti-COVID rules. They haven't really been able to take advantage of the pent-up demand because they've been shutting down so frequently. They also haven't been able to produce as much. There's also geopolitical risks, and there's also regulatory risks there as well. However, what I would say though is things are starting to get incrementally better. Okay, they are, the Chinese government has said that they're going to do what they can to help stabilize the markets over there. They're also don't have the same inflation issue as we do over here. They're also cutting rates while most of the world is raising rates. So they're in a little bit of a different position. They still have a few headwinds, but if you think about it, they're one of the only regions that are well on their way into the early phase of the market cycle. And as I mentioned, they haven't really taken advantage of the pent-up demand in China. So should they move out of recession phase and it's early, it could be a good opportunity to take advantage of opportunities in emerging markets. Now, I'm just going to touch on some, major themes that have really driven a lot of the volatility in the markets, and I'm sure a lot of, conversations that you've been having with Cherry. And first being, inflation. Inflation, I would say, is probably one of the biggest risks in your portfolio and what's been driving most of the volatility and all the decisions of the policymakers around the world. And that's simply because we're seeing rates that we haven't seen in over 40 years. So it's very unfamiliar grounds to a lot of us because a lot of us haven't been investing for over 40 years. But because these rates are so high, this is what's caused the Fed to be, and the Bank of Canada and central banks to be very aggressive with their policy. So the way Fidelity looks at inflation is in three different buckets. The first is oil, which we're starting to see come down quite significantly over the past couple months. Commodity producers have dropped in about 20%. So those should start falling off of inflation numbers. The second is supply chain disruptions. That has an inflationary pressure. Our research indicates that it's going to take about 12 months to start to normalize and ease. And then the third area of inflation is how tight the labor market is. What we mean by that is unemployment is extremely low. So as a result, we're getting wage growth. So essentially all of those workers are either demanding more income because to match inflation, which has that increase of wage growth, or they're asking their employers, or they're leaving their employers and asking for higher wages. So when you increase wages, that's a little bit stickier in nature because they can't reverse that impact. So this is the portion of inflation that our portfolio managers are most concerned about. The other numbers should start to fall off, but the part where we're most concerned in getting down to the target of 2% is the fact that the labor market is very tight and we're still seeing wage growth happen. So Fidelity's belief is that we're starting to peak out, which we saw exactly take place today. Today we got the US inflation number. It dropped from 9.1 to 8.5. The market celebrated this information because we've priced in so much information about inflation being very, very high. But the expectation is that inflation will start to fall off in a meaningful way for the next foreseeable future. I would say until the end of this year at least. Where our portfolio managers again are concerned about is moving us from 4% to 2%, getting us back down to target. So I believe there's still room to protect your portfolios against inflationary impacts. The second is interest rates. Obviously, these go hand in hand. In order to combat inflation, you need to raise rates. In a lot, they still have another 100 basis points change, so about 1% left in both Canada and in the US. But what's interesting, because the markets are forward-looking, they're already starting to price in rate cuts for next year. Okay, so probably up until January, February, we're still going to raise rates, and then come February, the expectation is that the central banks, both the Fed and the Bank of Canada, will start to cut rates, start to ease their policy and go back to more of a neutral rate, a rate in which they're comfortable with. So our portfolio managers aren't necessarily concerned about the rates that are happening right now, but we're more so concerned about that final rate, because that's what's going to be indicative of whether we enter into a recession, whether we are in a recession. It's usually that last rate hike that triggers us into that next phase of the market cycle. So with that being said, I'm going to address probably one of the biggest concerns here is that we don't believe we're in a recession, and that the recession risks, while they are moderate, we're not totally fearful of a recession being as catastrophic as what we saw in the Great Financial Crisis, or the tech wreck, or the pandemic recession that we most recently experienced. You have to remember, not all recessions look the exact same. It could be more of a technical one, like 2 quarters of negative GDP growth, which we've just seen. But right now, there's a lot of positive in the economy. So for example, the US economy, which, a lot of our portfolios are weighted in, is still very, very strong. So like I mentioned before, unemployment is extremely high. Consumers are still spending. There's still a lot of job openings. And those people that are employed are making more money. And then the next biggest thing that the market's really reliant on is corporate fundamentals, aka companies' earnings, companies' profits. And despite the fact that we've seen a lot of market volatility, earnings have actually maintained, have been consistent, and have also grown. Okay, so despite the fact that prices have come down, companies are still actually making profits. So this is something super important, because if we were in a recessionary market, earnings and prices would come down at the same time, and we're not there yet. So until that changes, until earnings start to go negative, so companies start to lose money and lose profit, then we're not prepared to call this a recession just yet. Until there's a lot of layoffs, we're not prepared to call this a recession just yet. The economy is still very strong. So I've just shared a lot of information. I know, I hope I touched on a lot of different points, but all in all, in terms of what this volatility means and how do you position it going forward, we're seeing a little bit of relief in the market, as I alluded to before, especially that inflation number has come down today. The markets went up anywhere between 2 to 3%. So again, if you were sitting in cash, you would have missed out on this little rally. They'll likely continue to trend a little bit upwards, but we don't think that this is going to be a sustainable bull market. We think that we're going to continue to see a lot of volatility. And I think the only thing that, would be the serious catalyst for change where we could maybe bypass recession is if we fully get a grasp on inflation, it goes down to its target. If they stop raising rates, we don't have the war over in Russia, Ukraine. There are a lot of good things have to happen in order for us to be completely relieved of all of this volatility. So all I would say is, stay invested, stay diversified, work with Cherry, and make sure that you're still achieving your investment objectives. But now is not the time to make any massive changes. And if you do make some changes, I can give you after this presentation, how you can diversify and make sure you hedge out some risks, but also take advantage of the current market. I would say the bottom line thesis in your portfolio is making sure you have high quality stocks. What I mean by high quality stocks are companies that have little debt. They have very healthy balance sheets. They have a lot of great profits. Their earnings are very strong. They have large margins. So again, their profits are really good. They're a little bit more resilient in nature. They can handle economic downturns a little bit better than others. Those are the companies that are going to do well should we hit some sort of recession. So that's where you lean on active managers. That's where you lean on a company like Fidelity Investments that meets with these companies face to face and understands their balance sheets and their financial statements to help determine which stocks are which companies are high quality in nature. Another thing I wanted to kind of touch on is the fact that we have midterm elections. This tends to be a volatile year in years of midterm elections, especially leading up to October. This chart here shows you that historically, 6 months prior to the midterm election, the market peaks in about April. It's not necessarily the case this year because we've seen a lot of other factors driving a lot of the volatility. But what happens is in October, this month right here, then you see the market go on an upward trend. So the fact that we have inflation likely falling off, and you also have midterm elections and how the markets usually rally after midterm elections, you could have a good opportunity for some market upside. Another piece of good information or a good chart to show is that typically once you see inflation peak, the S&P 500, the US stock market, typically has positive returns 3, 6, and 12 months out. So here's any periods where we've seen high inflation and how the markets have performed 3, 6, 12 months out. Again, so the blue graph or the blue line, 3 months, or orange is 6 months, and then the gray is 12 months forward. So again, it's a good time to make sure that you're staying invested, endure the volatility. It's a normal part of investing because you don't want to miss the recovery. And I'll finish up on this slide here. I'm sure you might have seen this slide before, but essentially what this is showing you is despite the fact that you have market corrections, which are indicated by the green dots, most often than not, you see the markets finish off on a positive note. So in fact, dating back to 1986, there's only been 7 calendar years where the markets have finished off negative. Okay, so again, these are just showing you how often you see corrections of 5, 10, 15%. And what's more interesting is the times where we see those deeper corrections of 20, 30, 40%, it's the following years that have the greater returns. So again, you don't want to be timing the market, you want to be, it's the time in the market. because then you'll be able to participate in that great rally moving forward. So just some key takeaways, stay invested, make sure you're diversified, make sure you have exposure to other areas of the market that, maybe you haven't had exposure to before. It's very likely that the markets will maintain its volatility, but that is a very normal part of investing. It's normal, specifically during this phase of the market cycle. And if you do have the time horizon, it's a good time to take advantage of the discounts that are being offered in the market and really positioning your portfolio for the next 6-12 months, but also maintaining, again, that long-term perspective. Now, I'm going to touch on a few different fund ideas, maybe a fund or two that you're not familiar with, and then a couple that you're probably already investing in. So first is, Canadian large cap. This is a portfolio manager that not a lot of advisors had exposure going into this phase, because he invests, the portfolio manager, Dan Dupont, invests in areas of the market that do very, very well during periods of recessions, of late cycles, just because he's very, very defensive in nature. So this is a strategy, 51% Canada, 49% foreign. He can invest in anywhere across the globe, but it's predominantly going to be held in Canadian large cap stocks. I like Dan Dupont because he does very, very well during periods of volatility. So anytime the markets go down, Dan has a very impressive track record of protecting capital. So when you see here that's highlighted in yellow, downside capture is 33%. What that means, if the market were to go down 10%, he's typically only capturing 3.3%. So his portfolio won't go down as much as the market. So he's a very good portfolio manager to hold during times of high volatility. This also shows you how well his portfolio fares anytime the TSX has dropped more than 5%. The blue graph indicates any time the market has had volatility of a correction of 5% or more, and how well his fund has done relative. So again, he's done extremely well anytime the market has seen volatility. And here's his performance year to date. So despite the fact that you saw in the very first slide that Canadian large cap, that most indices are negative, Canadian large cap has actually been positive year to date, positive all through all time frames that are being reported here. And most importantly, the other funds that compete in this category are mostly negative. So he's ranked number one or outperformed 100% of the other funds that are in this category. And you can see here his numbers are very, very impressive over the long term. When you match him up against the Canadian stock market, he's almost more than doubled the Canadian stock market. So again, this is a great portfolio manager to hold to complement the other PMs and the other funds that you're currently investing in. Specifically, Mark Schnell. So Mark Schnell, who a lot of you are familiar with, he's more of an opportunistic investor. He has very high turnover. He's constantly trying to find the best ideas and trying to shift his portfolio to adapt to the current environment. Mark's really known well for his market upside, so capturing more than what the market does. Or when you pair him with someone like Dan Dupont, who performs better when the market is going down, by complementing these two strategies, your portfolio will have a much smoother ride. So Mark manages a few different strategies at Fidelity. Those that are available for purchase are Global Innovators and Canadian Growth Company. And I would say Mark's investment style is to find positive change. He's looking for companies where things are getting better and trying to sell those stocks where things are getting worse. And so, again, he's constantly shifting his portfolio to really take advantage of the change in market leadership. So right now, his portfolio is positioned in what he calls the left tail of the market. Those are companies that have low valuations, they're cheaper in nature, but yet the outlook of it is very positive. So Mark's finding good opportunities in what he's calling the scarcity trade. So things where the supply is very limited, but demand is high. That's resources, agriculture, materials, and now adding pockets of defensiveness as well to utilities. So he's very well positioned for late cycle and and as we approach into a recessionary phase. But he's also now building out a bucket or segment of his portfolio to help with the rebound. So should the market pivot, should we start to see, a more sustainable growth in the market, his portfolio will be able to gain, strong upside capture from the bottom. So he wants to maintain both offense and defense in his portfolio. So despite the fact that, the market has sold off significantly, he still maintained his number one position in both Canadian growth company, special situations, and also global innovators. So when it says 100% peers beaten, that just means that he's the number one fund in his category. So he very, very strong track record of consistently outperforming all other funds in his category. So here is how the fund is currently broken down right now. You'll see here the portfolio has radically shifted. You look here at how the fund was positioned just 12 months ago. Energy only made up about 7%. Now it's about 30%. Utilities and material as well are now make up a very large position. And probably just last year, he had a lot more technology exposure, consumer discretionary. So again, he's radically shifting his portfolio to take advantage of the different areas of the market. Because of his strong sell discipline, he's really been able to add value over time. So here's global innovators relative to the NASDAQ, S&P 500, and TSX, three major benchmarks. You can see here, since inception, how well he's outperformed the broader market. And then here's his longer track record. You pull special situations dating back to 2007, so pre-global financial crisis, where things were looking, very bad in the economy at that time. He's managed money through different phases of the market cycle. He's more than doubled the S&P 500, even though he's had 51% in Canada, and has made more than 5 times the TSX. So Mark is probably one of our best stock pickers. He does shift his portfolio quite viciously. Anyone who has a 3-year time horizon, I highly recommend making sure that you have money with him. He's going to be more different than any other portfolio manager. Here's Greater Canada. This is managed by Hugo Lavallee. All the portfolio managers I'm really talking about all have very, very different investment styles and are very complementary to each other. Hugo manages 3 different strategies at Fidelity. The one that's available for purchase is Greater Canada. It has outperformed 100% of its peers. So it's number one in its category over 3, 5, and 10 years. So fantastic track record. Greater Canada is 51% Canada, 49% foreign. So it's very similar to the geographical mix, as I mentioned, for Canadian large cap. But Hugo Lavallee is more of a contrarian investor. So he's looking for things that are out of favor and where things are selling off because no one believes that they have, a good runway to grow. That's when he's starting to invest in them. So right now he's finding good opportunities in the tech space, also consumer discretionary. So the stocks that we're buying things, like luxury goods, for example, or more less household items. And why we like Greater Canada is he typically captures majority of the market upside at about 108%, but less when the market goes down. So exactly why you pay an active manager typically outperform just when the markets are going down. Again, here's his exposure. He's also shifted his portfolio quite significantly when you look at the sector mix. Again, consumer discretionary, these are things that consumers want versus need. This is, a contrarian play because a lot of PMs are moving out of this space. So I would say with someone like Hugo Lavallee, it takes time for his investment thesis to come to fruition. But over the long term, as you saw by the long-term numbers, he does extremely well. Look at Greater Canada relative to a 50-50 benchmark with Canadian and US stocks. And you can see here all of the alpha he's been able to generate over this time frame. And the last one I want to talk about is Insights class. This is managed by Will Danoff. I mentioned to you as a closing remark of my market update, how you want to invest in high quality stocks. That's exactly Will Danoff's investment thesis. He believes that stock prices follow earnings. So if a company has strong or above average earnings growth, he believes that the stock prices will soon follow that earning trend. So essentially, this is a US all large to mega cap strategy, and it's focusing on the best of breed companies. So he's looking for companies that are the best within each of those respective industries. So traditionally, those are those high quality stocks and names that you're probably familiar with, which I'll show you in the next slide. But Will Danoff, he's one of our most infamous PMs. He's been managing money for over 30 years, been managing money with Contrafund in the US, which has significantly outpaced and outperformed the S&P 500. Just looking at Insights class, you'll see the top 10 holdings. You'll notice a lot of these names like Apple or Meta or Alphabet, Microsoft, Amazon. These are your FANG names. So these are companies that are going to be a little bit more resilient as we enter into the next phase of the market cycle. He has reduced his exposure to the tech space and also communication services. And that's simply because of higher inflation, rising rates had a little bit more pressure in some of those areas. But where he's maintained his exposure are those companies that are very, very profitable and continue to grow at above average pace and operate in those large and expanding markets. Another area he's been adding to is healthcare. Healthcare is a very defensive place to be. It's a safer place to be because consumers still buy their pharmaceuticals through times of recession, just as an example. So he's shifting his portfolio. He's trying to adapt to the current environment as well. And here's why we buy Will is because of his track record. Again, like I mentioned, Contrafund is the US equivalent. And over his 10 years since he's been managing this fund, again, over 30 years, he's more than doubled the S&P 500. This is the value of being essentially with any active portfolio manager. They're able to consistently add value, even if it's on an incremental basis, on a year by year, on an annualized basis. That helps you compound returns over time. That's why you're paying for these PMs to manage your money. And I will finish it up there.